Okay, welcome everybody, and we are now going to have part 2 of the introduction to Chapter 6. So I'm going to start out with a brief review of what we talked about in Part 1, about the acquisition, and then the depreciation of long-term assets, and we're going to talk about getting rid of them. So let me get my picture out of the way. And in the Excel file that I sent you before the problem that I'm about to work, there's a template, and you could come back and do this on your own later, but what we're going to do is we're going to complete this in just a minute. So, at the top of the page is the diagram of the asset we're going to be accounting for. We purchased some equipment that had a cost of $77,000. We're estimating we will use it for 8 years. And at the end of the 8 years, we believe it has a salvage value of $5,000. So over that 8-year period, we're going to be depreciating the difference between the cost and the salvage value. 77 minus 5, that'd be 72,000. Over 8 years, that would be 9,000 a year, or $750 a month. Okay, so that's what we're dealing with. Okay, now the cost, the 77, here's where it came from. On August the 5th, Acme Corporation purchased equipment costing $67,000. So we debited equipment for $67,000. We paid $2,000 to the trucking company for shipping. That'd be another debit to equipment. And then we paid another $8,000 to have a special foundation built for this equipment. So all three of those go into the definition of the cost of an asset. Remember, it includes everything that we give up to obtain the asset and get it ready for its intended use. So all three of these probably didn't happen in one transaction, but I'm just kind of putting them together for simplicity. But we debit equipment for all of those expenditures. So remember, we call those capital expenditures. We are capitalizing those expenditures by setting up an asset account instead of expensing it, and we're going to depreciate this total cost over time. So the total cost is $77,000, and that's how much we're going to depreciate. Now, we did this on August the 5th, so anytime you buy something in part of the way through a year, just round off to the nearest month. And so we're going to depreciate this for August, September, October, November, and December. That's 5 months. That would 5 times $750 a month. That would be $3,750. And so let me move this up. At the end of the first year, we're going to depreciate this equipment for $3,750, debit depreciation expense, and credit accumulated depreciation. Now remember, from now on, instead of crediting the equipment account, we're going to credit this contra asset account called accumulated depreciation for $3,750. Now remember, that accumulated depreciation, it's in the assets section of the ledger of the balance sheet, but it has a credit balance. And we've never had that before. It's there to offset that equipment. These two accounts go hand in hand, because that $3,750 credit doesn't mean anything by itself. It's there to offset this cost, indicating that this much has been depreciated so far. So at the end of the first year, we had $3,750 of expense, and that would show up on the income statement. And the original cost of $77,000 minus the accumulated depreciation, that would be on the balance sheet at the end of the first year. So at the end of year 1, we have a book value, a remaining value on the books of $73,250. That's the net result of the equipment account offset by the accumulated depreciation. And then, of course, we would close the expense account. Now, don't close the accumulated depreciation. That would defeat the whole purpose. The purpose of that account is to accumulate over time. It's not a temporary account anyway, so we're not going to close it. Okay, we go through the next year. At the end of year 2, we're going to depreciate an entire year this time. So debit depreciation expense and credit accumulated depreciation. So here is that entry. And so now, at the end of the second year, we have $12,750 of accumulated depreciation. So that would go into the balance sheet, offsetting the original cost. That doesn't change. It's still $77,000. So now at the end of the second year, the book value is $64,250. But the expense on the income statement for year 2 was $9,000. That was 1 year's worth of depreciation. At the end of the third year, we would depreciate it another $9,000. So let me do that here. Let's see how far I got to go. So we would depreciate the expense another $9,000, and the accumulated depreciation would now be $21,750. So the expense of $9,000 goes onto the income statement, but the original cost and now the accumulated depreciation at the end of year 3 on the balance sheet gives us a book value of $55,250. So that's how depreciation is recorded over time. You always debit the depreciation expense, credit the accumulated depreciation. The expense account closes at the end of each year. The accumulated depreciation does not. It accumulates. So the expense account gives us the depreciation expense in that year, and the accumulated depreciation tells us how much depreciation we've had to date. Okay, so that gets us to the end of year 3. Now suppose, move up a little bit here. Suppose we get to the end of year, or sometime in year 4, April 21st of year 4, we sell the equipment for $30,000. Okay, so we've used it for January, February, March, and most of April, so we're going to round off to the nearest month, and we're going to depreciate the asset for those 4 months. That'd be 1/3 of a year. So update the depreciation, debit the expense, credit accumulated depreciation. So that would be recorded and posted to the ledger. And now, at the time of the sale, we have a book value consisting of the original cost of $77,000 minus the accumulated depreciation of $24,750. We have a book value of $52,250. Now suppose we sell it for $30,000. I'm going to give you 3 ways that we might get rid of that asset. We could sell it for $30,000. We could sell it for $60,000, or maybe a fire destroys it and we don't get anything for it. If we sell it for $30,000, we're going to debit cash for $30,000. We're also going to get rid of the equipment. When you get rid of the equipment, and this, by the way, is perhaps the most missed question on the exam. When you get rid of the equipment, you have to get rid of both of these account balances. Remember, those 2 accounts, both of these relate to the equipment that we just got rid of. And so we're going to take that off the books. That means to credit the equipment account and debit the accumulated depreciation. So that's what we're doing here. And then the difference is, in this case, we need a debit to make this entry balance. What's happening is, in the green, you see item A, we had a book value of $52,250. We calculated that over here. A book value of $52,250, but we sold it for $30,000. rid of this thing. So if we had an asset on our books for $52,250 and we sold it for $30,000, sounds like a loss to me. When you sell it for less than book value, that would be a loss. Take the proceeds from the sale, subtract the book value, that gives us a loss of $22,250, and that would be a debit to the loss on the sale of equipment. So in the green here, that's the example of selling it for $30,000. Less than book value, so we had a loss. In the purple, part B, what if we sold it for $60,000? This time we're going to debit cash for $60,000, still get rid of the equipment, both pieces, the original cost and the accumulated appreciation. And this time we sold it for more than book value. That means that we had a gain, and that gain was $77.50. So we would credit the gain account for $77.50. And that's the $77.50 is the difference between what we sold it for and the book value, and that's actually what's represented in the journal entry. The debit to cash is what we sold it for, and these two accounts together represents the book value. The difference between the two is that gain in this case. Of course, the debits have to equal the credit, so that helps us too. In part 3, suppose we didn't sell it, a fire destroyed it, so we got nothing for it. So we're just going to take the equipment off the books, get rid of both pieces, and the book value is a loss. The entire book value represents a loss because we got nothing for it. So again, the proceeds were 0 minus the book value gives us a loss of $52,250. Okay, so we've had a couple of new accounts here: a loss on a sale and a gain on a sale, or a loss on a fire too. Gains and losses, where do they fall? Well, in the accounting equation. Well, gains and losses are under retained earnings. Gains are pluses to retained earnings, kind of like revenues, so they're credits. Losses are minuses to retained earnings, kind of like an expense, so they're debits. Under retained earnings, I've got them off to the side here because gains and losses are not part of our day-to-day core operations. Revenues and expenses, that's what happens day in and day out, buying and selling our product, that type of thing. We're not in the business of selling our old equipment, but whenever it happens, we do need to record whether or not we sold it for a gain or whether or not we sold it for a loss. Gains and losses are temporary accounts. They close at the end of the period, and they are on the income statement. So at the end, here's what's going to be on the financial statements at the end of this most recent period. Sorry. We're not going to have anything on the balance sheet because we don't have that asset anymore. 3,000 represents the depreciation expense we recorded for those first 4 months that we were using the asset. And then on the income statement too, we would have, in the first example, a loss, which would be a negative number, brings income down. If we had a gain, of course, that would add to income. But gains and losses are additional items on the income statement. They're distinguished. In fact, up here on the Excel file, I make a note that there's a discussion of gains and losses on these pages, 174 to 177, and you'll find a little chart there showing how gains and losses are just kind of off to the side. They're not part of the core operations like revenues and expenses. But gains do increase income, so they're credits, and losses decrease income, so they're debits. Okay, so what you might want to do is go back to the template, try to do that for yourself and practice some of the homework problems, and be sure and take the quizzes in Chapter 6 as well.